Good morning, students. How are you all? Hope you all are fine. Okay. We are now in the 8th lesson, isn't it? Bank reconciliation statement. This lesson we have started on the previous day. I think you should understand what is that bank statement. It is related to the previous lesson, the cash book. There also in the cash book we have one 3-column cash book, isn't it? There we have cash amount and bank amount, isn't it? Here on both the sides, cash column and bank column, and on the credit side also we have cash column and bank column. Okay, this debit side, here credit side we have. You should remember this cash book. Okay, the cash book you have to remember when we do problems in this lesson. So you should have a thorough understanding about the cash book that we have learned already. Now you should know about the passbook. Okay, passbook, we know our customer's account in a bank, that is called passbook, isn't it? What it is? Customer's account in a bank, that is called passbook, or we can say bank statement. When we deposit or withdraw money or whatever transaction we do with the bank, that will be entered in the passbook, or that the bank will enter in the our account, in customer's account in the bank, that is called passbook or bank statement. Understand? There they will enter. There if we deposit, they will credit. Understand? If we withdraw amount, they will debit. Okay, the passbook they will debit. Then the balance will be showing. If it is favorable balance, the deposit, if it is more, it will show that credit balance only. That is the favorable balance. We can say, okay, it is good. Okay, if we have more credit, that is favorable. But the balance may show debit also. That is unfavorable balance. Here, it may show debit balance. How? Because the business people, they open one account that is called current account. Everything I have explained previous day, once again I am repeating, okay, just to make you understand. Current account. This current account holders are mostly business people. Okay, business people only will be opening this current account. Ordinary people will open the savings bank account, or some people they may deposit fixed deposit into the bank. They are called fixed deposit holders. Okay, so they will fixed deposit account. So savings and current account. Here this current account holders are having a benefit. That one is the bank overdraft benefit facility. Okay, bank overdraft. What is this bank overdraft? Okay, bank overdraft, you might have heard this one or might not have heard this one. Okay, but you should understand this one. What is overdraft? We can withdraw money more. Okay, more money we can withdraw from the bank than what is available in our balance. Okay, for example, if we have 10,000 rupees in the bank balance, credit balance, okay, that is favorable balance in our account. That just imagine you are a businessman, businesswoman, and you have started current account with the bank, and they have only 10,000 rupees in the bank as the credit balance. Okay, now for the business you need today 15,000 rupees you need today. So you are allowed to withdraw this 15,000 from this current account. Okay, from the bank account. So that 5,000 is called what? Bank overdraft. Bank overdraft is 5,000. You have withdrawn 5,000 more than what was available in your bank account. Okay, this 5,000 they will charge that charges. bank charges. They will give that bank interest. Okay, interest on bank overdraft that you have to pay later because they are providing more amount, isn't it? So they are giving like a loan. Understand? If we get loan from the bank, we need to pay interest for the loan. The same way, if you withdraw money more from the our account as the bank overdraft, we need to pay interest on bank overdraft. Okay, some terms you have to understand. Okay, then now this cash book also uh, we have one column, so you forget about this cash column. You do not worry about the cash column. That will have only debit balance, isn't it? Debit balance only we will have. But this bank column and this one, okay, credit side bank, here when we say that is a favorable balance, because we deposit, if we deposit money into bank, where we will write, okay, bank account debtor to cash, we will write, okay, 10,000. And if we issue check to the our suppliers, we will write, okay, or we can say withdraw money from the bank, we will write by cash account debtor to bank. So credit side by cash, and we will write here 5,000. So now the bank balance, how much we have? By balance carry down 5,000. Okay, total 10,000. Here also 10,000. Then here we will write to balance brought down 5,000, isn't it? So here also we have debit balance. Okay, here we have debit balance 5,000. Here we have 5,000. But here this bank reconciliation statement we need to prepare when the balance in the bank column of the cash book 5,000 and bank passbook. Okay, here also we have 5,000, isn't it? Extra we have that here debit balance. Okay, here also we have debit balance. There 5,000 debit balance, but here this is unfavorable balance, isn't it? Because we have learned here balance in the bank passbook, debit means unfavorable, credit means favorable. Here in the bank cash book, bank column of the cash book, if it is debit balance, then that is called favorable balance. If we have credit, then unfavorable balance. Okay, because we have more deposit, so here more deposit, isn't it? More debit balance, so we get again two balance brought down 5,000. So debit balance, that is favorable balance. Here it is unfavorable balance. Okay, so it differs. It is not showing if here the favorable balance shows. Here also in the passbook also we should have favorable balance. That means the credit balance in the bank passbook. But we have different amount, isn't it? Different balance we have. So we should check the difference. When we will, why we should check these differences? We have learned that one, that difference between the bank column of the cash book and bank statement. We have learned that, isn't it? That you can learn. Now we need to find out why these differences occur. Okay, we learned that differences occur. Why these differences take place? Okay, why? Because of the time difference that we will learn in detail. Okay, time differences. Number one, time differences. Number two, errors they may make. Okay, errors making either in the cash book or in the bank passbook. Okay, now we will see what are the time differences. First one, check issued. check issued but not presented for payment. Check issued but not presented for payment. Here I will explain this one with the cash book. Okay. See, cash book where we will enter. Cash book. Okay, just imagine two columns I got taken, this credit side, this debit side, cash book, here bank column. Okay. Then here cash column. We are not entering in the cash column. Okay, forget about that one. So in the cash book where we will enter this check issued but not presented for payment. When we issue check to our suppliers, what is the entry that suppliers will receive, isn't it? Receive the check. So for example, we are A and Co, they are B and Co. So B and Co company receive and our bank will be credited, isn't it? So B and Co account debtor to bank. So we will write by B and Co account. Okay, if it is 5,000, we are writing like this. Okay, when we issue check issued, we are entering in the cash book. For example, 25th March. Okay, 25th March 2020. Okay, we have entered, we have issued a check. So at 31st March we need to close the accounts, isn't it? So here we have credited the bank account. Okay, bank column we have credited. So here the bank will show less amount, isn't it? What is this? It is payment credit. Here receipts. But when the bank will enter, okay, when the bank passbook, that means bank statement or bank passbook, when they will enter, once that check has been gone to the bank for payment. Okay, that is a check issued but not presented for payment. This check is given to whom? To B and Co. Just think that B and Co got the check and he is presenting in his bank. Okay, on 1st April or even 28th March also he can present it in his bank. Okay, 28th March he is presenting his check in his bank. Okay, in his bank he is giving and that bank will send that check to our bank. Okay, A and Co bank. This one bank statement passbook of A and Co. That is our. Okay, our passbook, our bank. So our bank it will send on 28th and it is coming and our bank officials they are entering. We know the bank passbook 3 column: balance, debit, credit. Okay, credit, debit, balance. Here that means deposit, withdrawal, balance. Okay, so they will, here they have to debit, isn't it? They are not depositing, they will get the amount from our bank. So they will write here 5,000 when they are entering on the date, okay, 3rd April. Okay, the balance will be, okay, just imagine if the balance will be reduced. Okay, 5,000 will get reduced. So you have to imagine, okay, why this difference occurs? Because of the time difference. Why the time of entering in the cash book and the time of entering in the passbook differs. That only I am explaining to you. Okay, when we enter in the cash book, when we are entering 25th March, there itself we have credited. Okay, so this cash book shows what? Less balance. Okay, less balance. Here the passbook on the same day, which one? Okay, at the end of the year, 31st March, here deposit 10,000 example, here it will show 10,000, but here we have already credited this one. Here the bank has not debited the 5,000, so here the bank balance will be more. You see, the cash book shows less balance, the bank passbook shows more balance. Understood? That is why this difference occurs. Understand? So, check issued but not presented for payment, you can conclude what cash book shows more balance. Cash book shows more balance, but the passbook or the bank statement, passbook and bank statement are same. This one will show the less balance. Okay, now the second one I will explain. Check deposited, just opposite of this one. Okay, checks deposited into bank but not yet credited. But not yet credited. You should understand the meaning. Okay, we have deposited the check in our bank, but they have not yet credited. Here you see, we have issued the check to our customers, but it has not gone for the payment. It is not yet presented in our bank for payment. Here we deposited the check into the bank, but not yet credited. Because what are these checks? What are these checks? These checks we have received from our customers. Okay, these checks we have received from our customers. But what are those checks? These checks issued to our suppliers. We know why we are, who are our suppliers? We purchase goods from these suppliers on credit. Here we sell goods to our customers, these people, for credit. That is why we will receive amount from them. So they have given us check. Here we need to pay amount to our suppliers. We have issued checks to them. Okay. So these checks we have in our hand. That check we have deposited into bank. So when the business people, okay, business point of view, we will enter in the cash book. Where we will enter? When we deposit check into bank, what is the entry? Bank account debtor to cash, isn't it? Bank account debtor to cash. So bank debit to cash we will write. Okay, here how much? Okay, 5,000 we are entering. Okay, which date? The same, time difference only. We are entering this cash when at the time, that date, okay, same date we can say. Okay, 25th or 26th March. Okay, at the accounting end of the accounting year, it may not be entered. That is why it is there difference arise. Okay, 26th March they are depositing. Okay, we have entered. But that bank, what they will do? They will send those checks to the concerned bank. Okay. We have entered on 26th March. Then these checks, we are sending to the bank, isn't it? The bank will enter this one when the checks have these checks will go for collection. Okay, these checks will go for our customers bank, and it will be coming. If there is enough amount in our customers account, they will honor that one. Okay, that check honor, that is called check honor. So when they receive that amount in our account, they will credit here 5,000. There it will take some time, maybe 4th April only the amount is coming. So they will credit. Okay, here again 5,000, again it will become 10,000. Okay, deposit they will add. Okay, here withdrawal again 5,000 only balance will be there. Okay, so here you see, we should see on 31st March what is happening here, not entered, but here it is entered. Okay, so the cash book balance, the cash book balance is, here I have taught you the opposite. Here check issued, see here it will reduce the amount. Okay, sorry students, when we issue check, it will reduce our balance, cash book balance. If we enter more payment, it will reduce. Okay, that bank passbook will show more balance. Okay, here balance, it shows more. Here you see, when we issue the checks deposited, we are entering on the debit side. That means deposit to more, receive to more. It will show more balance. But the passbook balance, you see, on this one, now it is increasing, isn't it? 4th April only it is increasing. But on 31st March, it shows only 5,000. Okay, so that is showing less balance. Understand? That is it. Okay, students. So you should understand this main thing: check issued but not presented for payment, check deposited into the bank but not yet credited in our account. Okay, you might have understood this to the other. Just to try to understand and listen to the video carefully, listen to my teaching and try to understand. I will teach you the next one in the next class. Thank you, students.